imagine handing over like $1.75 trillion to a developer for a luxury high-rise. But they keep all the keys, and, you aren't even allowed to choose when you use the elevator.
Right, which sounds like an absolute nightmare.
Yeah, it sounds like a real estate scam. But today, that isn't some hypothetical scenario. It's actually the reality of the new SpaceX IPO.
It really is.
Welcome to NovaStream, everyone. If you are just joining us right now, you are tuned into the 24/7 home for live crypto markets, global financial indices, and the breaking news that's, well, driving all of it.
And there's a lot driving it today.
Oh, absolutely. I mean, if you look at the live metrics flashing on the channel right now, it is just a sea of movement. We've got dynamic sparkline charts tracking Bitcoin and Solana. The S&P 500 and NASDAQ tickers are churning away. And of course, our auto-curated breaking news feed is scrolling nonstop at the bottom of your screen.
Yeah, the sheer volume of headlines coming across the wire today from, the financial sector, tech, Washington, it's frankly staggering. And sitting here looking at this high-tech trading floor cityscape behind me, I mean, it feels like the perfect visual representation for the absolute density of data we are processing right now.
So for this segment, we are bringing you the highlights of the day. Our mission here is to take this massive influx of today's headlines, it is June 4th, 2026, by the way, and extract the essential takeaways so you can actually navigate this highly volatile landscape.
Which is crucial, because there is a massive overarching theme today.
Yeah, there really is. It's connecting almost every asset you see on the screen. It is this violent collision between assets being priced for perfection and then the arrival of just unforgiving reality.
Right.
We are watching astronomical expectations in tech, in crypto, and even in politics violently crash into market mechanics and historical precedent. So let's unpack the deeper mechanisms behind these moves.
Because the underlying mechanism is where the actual value is for you, the listener. When markets price something for absolute perfection, they leave zero room for error. And reality, as we are seeing today across the board, is rarely perfect.
Which brings us directly to the massive breaking news dominating the feed right now. The SpaceX IPO, trading under ticker SPCX. They are targeting a valuation of $1.75 trillion.
Trillion with a T.
Trillion with a T. But let's look at the structure of this offering, going back to that luxury high-rise analogy. CEO Elon Musk is retaining approximately 85% of the voting rights.
Yeah, 85%.
Now, considering that passive ETFs tracking the NASDAQ 100 are going to be mathematically forced by their own prospectuses to buy into this stock after 15 days, is this simply a massive, unavoidable trap for everyday retail investors who hold those funds?
Well, the historical context suggests your caution is incredibly warranted here. If we look at a recent Truist analysis of 30 major tech IPOs, the data shows that their first-year maximum drawdowns average about 55%.
Wow, 55%.
Yeah, that is a massive haircut for anyone buying at the top. And that $1.75 to $2 trillion valuation inherently assumes, flawless execution of highly speculative ventures decades into the future.
Right. But I want to push back on the risk profile for a second, because people watching will say, well, it's SpaceX, they land rockets backward. Of course I want it. What is the specific danger of that 85% voting control?
The specific danger is what we call extreme subsidization risk.
Okay, what does that mean?
So, because Musk holds that 85% voting power, shareholders have virtually no recourse when it comes to capital allocation. Portions of the billions in cash raised from this SpaceX public offering might be diverted entirely legally to cover the immense cash burn at his other private ventures.
Wait, like his artificial intelligence company, XAI?
Yeah, XAI, or even the X social platform. You might think you are buying rocketry, but you could indirectly be funding a struggling social media network.
That is a staggering amount of hidden risk. Hold on, though. What is the play for someone watching this stream who wants exposure to the space sector, but absolutely refuses to get caught in a 55% post-IPO drawdown or a governance trap?
Well, if you require a margin of safety, the historical data suggests waiting out the initial hype cycle. Observe how the stock handles those early quarterly earnings, or wait for the insider lockup expirations to see if early investors dump their shares onto the open market.
Right, wait and see.
Yeah. Alternatively, you don't actually have to buy the IPO directly. Investors have historically used closed-end funds or active ETFs to get that exposure with a very different risk profile.
Let's pause right there for a second. Clarify closed-end funds for us in plain English. How does that protect an investor?
So a closed-end fund raises a fixed amount of capital through an initial public offering and then issues a fixed number of shares that trade on an exchange, just like a stock. The private shares fund, for example, already holds SpaceX and XAI.
Oh, I see.
Because these funds trade on the open market, their share price can actually trade at a discount to the net asset value of the companies they hold. So it allows you to gain exposure to the asset, often at a reduced premium, while a professional manager handles the sizing of the position within a broader portfolio.
That makes the entry strategy a lot clearer. Now let's pivot to a completely different approach to going public today. Quantinuum, ticker QNT, just priced their upsized IPO at $60 a share, raising $1.68 billion. They sold 28 million shares today.
A huge move.
Yeah, and what stands out to me is that this is a traditional IPO. I mean, for the last few years, emerging tech loved to use the SPAC route, right, the special purpose acquisition company, to basically go public via a backdoor merger.
Right, and avoiding traditional scrutiny. But this is a very deliberate structural choice by Quantinuum. Going through a traditional IPO is really about establishing institutional trust. Quantum computing has been making serious strides toward commercial viability, but, it still sounds like science fiction to a lot of traditional asset managers.
Wait, isn't a traditional IPO just a slower, much more expensive way to lose investor money? If this quantum tech is still years away from actual commercial viability, why even bother with the roadshow?
Because the roadshow acts as a brutal filtering mechanism. By submitting to the rigorous scrutiny of a traditional IPO, the intense audits, and facing the toughest institutional investors in person, they are signaling unshakable confidence.
Okay, that makes sense.
They're essentially asking the market to validate their technology fundamentally, proving their books are clean and their science is real, rather than using a SPAC, which, like we said, often bypasses that deep level of regulatory and institutional vetting.
So it is really about buying legitimacy, not just capital.
Precisely.
And while Quantinuum is building the future, SpaceX's current technology is already dismantling the past. Look at the breaking alert we just got on AT&T, ticker T. They just saw their worst day in 8 months, dropping 4.4%. And the catalyst is entirely tied to SpaceX's Starlink.
Yeah, the telecom sector is having a brutal realization today about unit economics. Analyst Timothy Horan at Oppenheimer just downgraded AT&T from outperform to perform. The market is suddenly waking up to the existential threat of Starlink's new V3 satellites.
But terrestrial broadband is deeply entrenched. We have fiber cables running to millions of homes. How does a satellite in low Earth orbit actually threaten copper and fiber in the ground?
It all comes down to capacity scaling. The new V3 satellites have 10 times the data capacity of the previous models.
10 times.
10 times. When you multiply your capacity by 10 without multiplying your launch cost by 10, the cost to deliver each gigabyte of data just plummets. Analysts are warning that this massive increase in efficiency will drive down satellite service prices to the point where they can directly rival legacy terrestrial broadband.
Oh, wow.
Yeah, so AT&T is getting punished because Wall Street realizes their multi-billion-dollar physical infrastructure suddenly looks incredibly vulnerable to an invisible network in the sky.
It is fascinating to see legacy tech punished for not keeping up. But here is where it gets really interesting. What happens when the market darling, the company actually building the new infrastructure, gets punished anyway?
Which brings us to Broadcom.
Yeah, Broadcom, ABGO, they just reported a record fiscal second quarter. Their custom AI chip revenue was up an insane 143% to $10.8 billion. Total revenue hit $22.19 billion. Yet the stock fell sharply today and actually dragged down the entire semiconductor sector. How does a company grow its AI revenue by 143% and still get punished by Wall Street?
Because the stock's recent rally to all-time highs essentially priced in a miracle, leaving zero margin for reality. The market wasn't just demanding good historical numbers, it was demanding a massive upward revision of the entire future roadmap.
So they didn't give them that revision.
No. Broadcom's CEO, Hock Tan, decided to maintain their long-term AI chip sales target at $100 billion instead of raising it. Plus, their third quarter AI guidance came in at $16 billion. Now, that is a massive year-over-year increase, but it marginally missed estimates from Visible Alpha analysts who wanted to see $16.36 billion.
So they missed a future projection by a fraction of a percent, and the market throws a fit.
Yeah. It highlights a major structural shift for the company's risk profile, too. Broadcom used to acquire software companies to buffer the highly cyclical boom and bust nature of the semiconductor business. Software provides steady recurring revenue,
Right.
but that software segment is shrinking as a proportion of overall revenue. Broadcom is increasingly becoming a pure-play AI hardware stock, tied directly to the massive capital expenditures of partners like Alphabet and OpenAI. When you are a pure play in a hype sector, any hint of conservatism in your guidance is treated as a massive red flag.
So if Broadcom is suffering from astronomical expectations, the crypto market is currently suffering from a severe mechanical trap. Looking straight at our live NovaStream crypto charts right now, Bitcoin is sitting at $65,896.
Ouch.
Yeah, down 2% in 24 hours, down 13% on the week. Retail sentiment flashing on our feed is categorized as extremely bearish.
The weakness here isn't just about bad vibes, it is deeply structural. According to a new Glassnode report, Bitcoin is currently trapped in what we call a negative gamma zone.
Okay, let's break that down. For the listener who doesn't, trade complex options derivatives every day, how does a negative gamma trap actually function in practice?
Think of it like being a driver in a car where the cruise control is wired backward.
Yeah.
If the car speeds up, the computer violently slams on the brakes. If it slows down, it slams the gas. The market makers, the institutions providing liquidity for these options, are the computer. The largest clusters of this negative gamma are sitting right between $65,000 and $70,000, with the sweet spot around $66,700.
So what happens when the price is in that range?
When the price sits in this zone, market makers are mathematically required to buy the underlying asset when the price drops and sell it when the price rises, just to keep their own portfolios neutral.
So they are actively suppressing breakouts and accelerating drop-offs by trading against the momentum. No wonder retail investors feel like they can't win right now.
The pain is highly visible in the data, too. We are seeing $1.35 billion per day in realized losses, with $770 million of that coming from long-term holders finally throwing in the towel.
Man, that's brutal.
And this mechanical trap is compounded by macro pressures. U.S. job openings just hit 7.62 million. That pushed the 10-year Treasury yield back above 4.45%, sparking fear that the Fed might hike rates again. When yields rise, institutions de-risk out of volatile assets. We've seen $4.21 billion in outflows from spot ETFs recently.
And most of those investors bought high, right?
Yeah, the average spot ETF investor is actually underwater right now, with an aggregate cost basis sitting up near $83,000.
So the mechanics and the macro environment are squeezing the asset simultaneously, which makes this next corporate drama pretty bizarre. Alphabet, Google's parent company, is doing an $84.75 billion capital raise. That includes $15 billion in convertible preferred stock and $40 billion in an at-the-market offering.
Right.
Immediately, Fang Lei, the CEO of MicroStrategy, which holds a massive amount of Bitcoin claims, Google is using financial tools that his firm, quote, popularized.
The irony there is quite thick, considering critics immediately pointed out that Microsoft's issued $1 billion in convertible preferred shares back in 1996. MicroStrategy certainly didn't invent corporate finance.
Right. But let's actually explain what MicroStrategy is doing. Before we laugh at them, clarify what convertible perpetual preferred stock actually is and how it is different from just taking out a standard bank loan to buy Bitcoin.
Sure. A standard bank loan requires regular principal and interest payments, which drains your cash flow immediately. MicroStrategy's instrument, trading under the ticker STRK, is a hybrid. It pays an 8% annual dividend to the buyer, and it can convert into 0.1 shares of MicroStrategy common stock. They market this as digital credit.
So they get cash up front.
Exactly. By issuing this, MicroStrategy gets cash up front without the immediate pressure of a traditional loan, and they use those proceeds to buy more Bitcoin.
But that leverage only works when the underlying asset goes up. Today, their stock dropped 7.01% in regular hours and another 2.19% after hours.
Wow.
Why is this strategy suddenly collapsing on them?
Because they made a leverage bet on an asset they do not control. And that asset is currently caught in the structural downtrend we just discussed. Because Bitcoin has fallen below their average acquisition cost, MicroStrategy is facing massive unrealized losses. They're actually selling some of their Bitcoin holdings below cost right now just to manage their obligations.
So MicroStrategy made a massive bet, and right now the math is just eating them alive. But what happens when you actually control the entire ecosystem, like a sports book, and the math still turns against you?
Oh, this is a fascinating situation.
DraftKings and FanDuel are currently staring down a mathematical nightmare with the NBA Finals between the Knicks and the Spurs.
It is a brilliant problem of liability management.
The books are completely trapped. If the Knicks win the championship, the sports books lose heavily because New York attracted roughly half of all the money wagered on the finals all season long. The raw volume of cash is just too high to offset.
Right.
But if the Spurs win, the books still lose because San Antonio represents the biggest remaining liability on the long-term futures book. There is literally no mathematical outcome where the house wins here.
It points that you can build a massive enterprise, write the rules of the game, and still end up totally cornered by the realities of probability and public sentiment.
If overwhelming capital can't override the fundamental math of a sports book, let's apply that to the political sphere. Look at Tom Steyer, the billionaire former hedge fund manager. He spent $216 million of his own personal money on his 2026 run for California governor.
An incredible amount of money.
And he is currently on track to be completely eliminated from the race to replace Gavin Newsom. We know what happened, but why didn't $250 million move the needle?
Because of the saturation point in modern media ecosystems. Overwhelming financial force cannot simply buy public sentiment if the underlying mechanics of the race don't support it.
So just spamming ads doesn't work.
Not endlessly, no. Once you have bought every available ad slot in California, spending another $50 million literally cannot buy new attention. It only annoys the voter base. It is voter inelasticity. Steyer reached the limits of what capital can achieve without organic momentum, resulting in a sunk cost of massive proportions.
Capital definitely has its limits. Now, while Steyer's war chest couldn't shift the reality in California, there are massive institutional shifts happening at blinding speed in Washington today.
Absolutely.
But before we dive into this final segment, I want to make something explicitly clear to you, our listener. On our breaking news feed here at NovaStream, we pull headlines from across the entire political spectrum. We want to be very clear to you. We do not take sides, and we are not endorsing the viewpoints of any political content we discuss. Our job is simply to impartially report the facts and ideas contained in the original source material so that you are fully informed.
A vital disclaimer, given the gravity of today's developments.
So, looking at the feed, President Trump announced via a video posted by Dan Scavino in the Rose Garden that he plans to nominate Todd Blanche as the permanent Attorney General. Blanche is his former defense lawyer and currently the acting AG.
If that formal nomination proceeds, it guarantees a severe confirmation battle in the Senate. Objectively speaking, Blanche faces immense structural hurdles. Lawmakers have intensely questioned his previous role in the Jeffrey Epstein case, as well as his authorization of prosecutions against individuals targeted by the president.
And there's a funding controversy too, right?
Yes. Furthermore, there is fierce congressional backlash over a proposed $1.8 billion fund that would use taxpayer money to compensate allies of the president who claim they have faced political persecution.
Now, the intelligence community is seeing a shakeup as well today. Bill Pulte has been named Acting Director of National Intelligence. How does someone who currently leads the Federal Housing Finance Agency end up running national intelligence?
That is the core of the controversy. Pulte has no known background in intelligence, defense, or national security. He has, however, been a highly aggressive advocate for prosecuting Democrats.
So it's an appointment based on alignment?
Right. Appointing loyalists over subject matter experts is a specific administrative strategy, but it triggers immediate institutional blowback. As a direct result of this appointment, Democrats in Congress are now threatening to hold up the reauthorization of a vital national security surveillance program. The tension is freezing legislative function entirely.
And finally, a major reversal over at Homeland Security. Secretary Markwayne Mullin confirmed to Congress that IC training for new recruits is going back to its standard 72-day curriculum on July 1st. For the past year, they had shortened that training to just 42 days.
Right.
Why did the 42-day curriculum fail fundamentally?
This brings us back to that core theme of the day, the consequences of moving too fast. That 42-day accelerated program was implemented to facilitate a massive hiring surge and ramp up deportations quickly. But former IC attorney Ryan Schwank heavily criticized it, revealing that vital classes on Fourth and Fifth Amendment rights, lawful arrests, and de-escalation tactics had been severely scaled back.
So they prioritize speed over constitutional training, but what is the mechanical failure there on the ground?
When you speed through constitutional training, field agents make procedural errors during search and seizures. That creates an administrative nightmare where arrests are invalidated in court due to civil rights violations, exposing the agency to massive legal liability.
Wow. So the shortcut backfired completely.
Yeah. DHS leadership initially defended the shorter program by claiming they simply increased class frequency, But the reality of botched field operations and pressure from lawmakers forced their hand. They yielded to reality and restored the full 72-day timeline.
Which perfectly wraps up today's highlights. Whether we are looking at the $1.75 trillion expectations of the SpaceX IPO, Broadcom getting punished for minorly missing a future target, Bitcoin trapped in an option squeeze, or a law enforcement agency having to walk back its accelerated training. Today's headlines prove one thing. Aggressive ambition always, eventually, has to answer to structural reality.
It leaves us with a critical thought to ponder. If the market is currently punishing tech giants for missing perfect projections by a fraction of a percent, what happens when the first major AI system, which we are rushing to integrate into everything from telecom to national security, hallucinates in a way that causes real-world physical damage? We are eagerly pricing in the limitless profits of tomorrow, but we might be completely ignoring the unprecedented legal and structural liabilities of next year.
A phenomenal question to leave on. Thank you so much for tuning in to NovaStream's highlights of the day. Keep your eyes on those live tickers, stay curious, and we will see you next time. Goodbye, everyone.